Focal to the financial space, in a recent note, JM Financial says investors are worried about muted loan growth in the sector. They also expect largely flat net interest margins in H2 of FY26. We are now joined by Ajit Kumar, lead research analyst, BFSI at JM Financial Institution Securities. Thank you so much, Ajit, for joining us. First up, give us the main feedback that you've received from investors. Despite so much of liquidity injections that the sector has received, you're saying that investors believe that they don't expect too much of credit growth as far as FY26 is concerned. Why is that?
Yeah. So thank you for having me. So yes, we met around 25 foreign investors in Singapore and Hong Kong last week on India financials. Their feedback was mix of caution on current state of affairs with hope of recovery in second half of FY26 or FY27. Three feedback which I wanted to highlight here. One, obviously, as you highlighted, investors were worried about muted loan growth in sector. So between end of March 2025 to end of May 25, so for the first 2 months of this financial year, credit outstanding for banks is broadly flat versus, let's say, 2.1% growth same period last year. Now, this series of steps taken by the RBI in last 6 months, like repo cut, CRR cut, easing of various, guidelines on gold loan, project finance, LCR regulation versus draft regulations, and deferment of ECL guideline were very well received. This should lead to improvement in credit growth in second half of FY26. Having said that, still investor credit growth expectation for FY26 was more like 11% YOY right now, lower than, let's say, 12 to 13% YOY expectation in March 25. So there is a decline in the expectation. While we believe that there is going to be pickup in, let's say, credit growth in the second half, but there is a decline in the expectation, let's say, compared to 2 months back. So the reason for this, I think, material improvement in credit growth in FY26 is unlikely until unless, income level of the larger population improves, which leads to a real increase in demand. So that's the main reason why we believe that, credit growth for the full year should not be more than, let's say, 10.5 to 11% on a YOY basis.
All right, we take that point. I look at some of your top picks and you are positive on SBI, BOB and Axis Bank. I'm a little curious about Axis Bank because there are a lot of people who, met with analysts, etc., met with the companies, etc., and said that maybe for Axis Bank, the growth looks a little muted in the first quarter. Despite that, your positivity, if you could explain?
Yeah, you're absolutely right. So, I mean, the loan growth for Axis Bank is relatively lower as compared to some of the other large banks. But having said that, when there is a decline at the sectoral loan growth itself, the other large banks will also see, decline in the loan growth, whether it is ICICI Bank, whether it is, let's say, Kotak Mahindra Bank. In most of the places, we will see, growth decline in this year, financial year versus last year. There is going to be a broad-based slowdown in loan growth for the NBFCs as well. In that scenario, when we compare Axis with somebody else, let's say like for example, ICICI, Kotak and SBI, there is a value differential, right? And when the delta between, let's say, loan growth of Axis versus others comes down, valuation-wise, Axis look much better as compared to some of the other large banks.
Okay. Ajit, one key point that you mentioned and something that the street is tracking very closely is the net interest margin.
Yeah.
For banks, it's expected to moderate in H1. You're saying it's expected to remain flat in H2. Why? And number two, a lot of optimism is built around the NBFC pack, especially given the kind of rate cuts that we've seen. You don't seem to be so optimistic. Why?
Yeah. No, so we have made peace with the fact that for banks, margin is going to decline in first half and that largely be flat as the positive impact of CRR cut, flow through in second half. So CRR cut is getting applicable from September onwards, which is going to give, positive impact on the margin side. However, for some of the NBFCs and mid-sized bank with higher share of floating, higher share of fixed rate book, the general expectation is margin is going to expand in this year versus, let's say, FY25. But our sense is this is not going to be happening in this rate cut cycle. The reason for this is we are getting into this rate cut cycle when there is a elevated pressure, elevated asset quality pressure in the unsecured loan. Now all the mid-sized banks and NBFCs want to get into secured segment all at the same time. So everybody wants to do affordable housing, everybody wants to do vehicle financing. So there is a shift in loan mix which is happening from unsecured loan to secured loan. And that is leading to, pressure on the margin side. And there is a, elevated pricing pressure in the secured loan as well. And that is why we believe that FY26 margin for most of these names should either be flat or, let's say, in a best case scenario, only marginally higher, maybe let's say 10 to 15 basis point higher versus FY25 against, let's say, 100 basis point of rate cut for, rate cut that we have seen. Even the management commentary suggests, in a similar line, like for example, Bajaj Finance, right? In their investor presentation, they have said that, cost of fund will go down, but my margin is going to remain flat, on a YOY basis. That basically means that yield is under pressure. We cover roughly 30 to 35 names here, and more than, let's say, 25 to 30 names have reported decline in yield in fourth quarterly result. So even before we could have seen, benefit on the cost of funding side, yield is under pressure. There is no pricing, power for the lenders, when the sector loan growth is muted.
That really, points to the problem that we're looking at here, Ajit. We're not as worried about margins because that will take care of itself if the loan growth does come by. You spoke about higher competition. You spoke about, similar profiles of people who everyone is now chasing that has a pressure on the yields, etc.
Yeah.
So whether growth comes by or not is the big macro challenge right now. But the important point here, you said you covered about 30, 35 names in the space. I don't know whether it's conspicuous by its absence or you don't, cover this name. There's Indescent Bank. And the reason why I ask you very specifically is about 7 days ago, there was a large, foreign brokerage that changed its view on the stock. And this was the first after that entire debacle that we saw on Indescent Bank. So are you tempted to bite the bait here with a stock which is 50% lower? So if things remain the same for everyone, how much of that is in the price, etc.? Would you have a view here?
Yeah. So on Indescent Bank, we have a hold rating. The reason for this is, I don't want to look at, Indescent Bank fundamentally till the time, all the mess is cleared, right? So, after every, let's say, 1 week or 2 weeks, there is one news or some other news which is coming out. So till the time, all those mess is, completely cleared, till the time I don't have confidence on the, this softer aspect, we don't want to look at, Indescent Bank at this particular point of time, from fundamental perspective.
Just as an academic exercise, have you done, the worst case scenario analysis, bear case, what would the stock be priced at, and basis which, where is it right now?
So see, fundamentally speaking, even in best case scenario for Indescent Bank, ROE trajectory should not be more than, let's say, 7-8% going into, let's say, FY26 and FY27 as well. I don't think Indescent Bank will be able to cross, double-digit ROE by FY27 as well. Given where the valuations are, things looks completely, priced in. But having said that, as I said, the moment, I have greater confidence on some of the softer issues, we will obviously, have a relook at the name.
Well, thank you so much for joining us. It was a very good conversation and also moderates some of the optimistic expectations that the street has built in. But it's now time for a quick break. Pritesh Mehta from Securities will join in with some trading strategies on the other side. Stay tuned.